So, good morning, everybody, and welcome to November's payroll update. First of all, I do need to apologise to you because there is some building work going on next door. I'm delivering this update wearing my headset with the microphone very close to my mouth, so hopefully it's not going to interrupt us too much this morning. We'll just have to press on and hope that it doesn't interfere and that you can hear me okay. So, hello everybody. Welcome to this month's update. I'm Helen Hargreaves and I'm Head of Payroll Policy here at MBKB. I do realise that at the moment these payroll updates place a heavy focus on businesses who are furloughing staff and what changes have come into the job retention scheme. But that doesn't mean that the world has stopped. So sometimes it feels like it, but it hasn't. So once again, I've included other issues that you need to know about, not least Christmas. So if we look at the agenda, we're going to start off with a look at the spending review because that took place last week. So I will fill you in on what you need to know about that. Then we're going to be having the usual COVID-19 roundup. Other news, and then we'll finish with a look at Christmas because it's on its way. And because we're delivering this month's update a bit differently to the ones we've delivered so far, in that I'm flying solo today, I need to talk to you as well as keeping an eye on the chat box. So please do use the chat box to ask questions, and you'll see that there is an item on the agenda for questions there as well. So ask your questions as we go along. Hopefully I will see them and I can answer them as we go along. But if I do miss any, don't worry, we've got time for questions at the end of the session, so I'll pick up any that we've missed there. So, normally at this time of the year, the Chancellor would have delivered his autumn budget. And while it's understandable why we haven't had a budget, what with everything else that's been going on, it's been quite worrying for payroll practitioners. Those who are new to the profession might not get why the budget is crucial to the payroll calendar. So, let me explain first of all why it matters. For many people, their sole interest in the budget is to find out whether they're going to need to pay more for fuel, cigarettes, booze. And let's be honest, that rings true for most of us as well, doesn't it? But payrollers do have a professional interest in the Chancellor's annual financial statement, because that's when we normally find out what the income tax and national insurance rates and thresholds are going to be for the following tax year. It might not be as exciting as cigarettes and booze, but it's no less essential. The budget used to take place in spring, but in the last few years, it's been held in the autumn about this time of year. And that works well for payroll because it gives payroll software providers time to add the new rates into the software for the new tax year. The reason we need to know the tax and national insurance rates before Christmas is because the software developers need to be able to get the rates into the software before it gets released in the new year. And it's not just a case of changing the numbers and then releasing the software to the customers. Software developers need to test that software. They need to make sure that everything's in the right place and that all the calculations are correct. And they have to do all that before they can release it to you. And then, of course, when it does get released to you, then you also need to test the software and make sure that the calculations are correct to reassure yourself that you're ready to go from the start of the new tax year. Things didn't go according to plan last year because the scheduled budget was cancelled as a result of last year's December general election. And that caused quite a bit of consternation because we were very late in receiving the NI thresholds. They came out just in time. And in Scotland, we didn't get the income tax rates and thresholds in time, so there was a delay in applying them. And that's why in training modules, you'll see that in 2020, the Scottish income tax rates took effect from the 10th of May rather than the usual 6th of April. So if we go through these one at a time, in the spending review, it's being confirmed that both the income tax personal allowance and the higher rate threshold will increase in line with the Consumer Prices Index, or CPI. And we're going to look at what CPI means later on. So it will increase in line with the CPI figure for September 2020. That figure will be used as the basis for determining what the national insurance limits and thresholds will be, and the rates of Class 2 and Class 3 NI in contributions will also be for the next tax year. We know that the CPI figure for September 2020 was 0.5%, 0.5%. So we could make an educated guess at what those rates will be, but we need to wait and see really what the official thresholds and limits are going to be when they're laid out by government. So if they know how they're going to do it, we just need them to tell us as soon as possible. The information is very welcome to know what's going to happen, because speculation was rife that there wouldn't be an increase to tax and national insurance. So we know now that there is going to be, we just need to get those actual figures. And I know that many of you work in the public sector, so let's take a quick look at what the Chancellor had to say about public sector pay. There were three main points about public sector pay. The first is that there will be a pay rise for more than 1 million NHS workers. Of public sector workers not in the NHS, the lowest paid will be prioritised. So 2.1 million public sector workers who earn less than the median wage. The median is middle point across the UK. So for those who earn less than that median wage of £24,000, they're going to receive a pay rise of a minimum of £250. But for the rest of the public sector, there's going to be a freeze on pay rises for the year 21-22. State pension was also had a strong influence in the spending review, and I know that it's going to seem like a lifetime away for most of you, but it will affect everybody. It's just it's going to affect some of us sooner than later. And it's important because it will affect just how much you will have to live on in retirement, and reinforces just how important it is to contribute to your own workplace pension and not just rely on the state pension, because that's going to be worth less in real terms than it is to pensioners today. Pensioners can see, pension savers can see their pots fall. So that's the money that you are accumulating to be able to spend when you're retired. Your pot could fall from 2030 as a result of the shake-up and how inflation is calculated. Why? Well, it's a bit technical, but it matters. And the cost of nearly everything that we do is governed by the rate of inflation. But there are two different rates of inflation. There's RPI, which is the Retail Prices Index, and there is CPI, which is the Consumer Prices Index. Now it's got a fancy new name, so now it's CPIH, because it's a Consumer Prices Index that includes housing. And what they're wanting to do is change how they calculate the cost of everything. So at the moment, the idea is to bring the calculations for RPI into line with the new Consumer Prices Index. It's seen as being more representative of the real rate of the cost of how things are rising, but in reality what it does mean is that the rate is going to be lower. So CPI is generally lower than RPI. The Chancellor, Rishi Sunak, refused to agree to the calculation change, but the UK Statistics Authority, which is behind the suggestion that we change the way we calculate things, can go ahead with the measures without the Chancellor's agreement as long as it waits until February 2030. When these changes do take force, they're expected to have far-reaching consequences because, as I've said, RPI is currently used to calculate price changes on everything from rail fares to student loan interest rates. And while 64% of defined benefit pension payers, so they're the final salary schemes, they use RPI to calculate their annual pension payouts. RPI traditionally is higher than CPI, so the latest data that we have from the Office for National Statistics lists CPI at 0.9%, whereas RPI is 1.3%. So that means that the calculations are going to have a negative impact for some, but there are some people who are going to benefit from it. So those who are likely to be negatively impacted are pension savers. So those who have a final salary scheme, those are schemes that are based on the salary and how long you've worked for your employer. With those, you get a lump sum each year in retirement that's usually uprated to account for inflation, and about 64% of the pension providers use that RPI to do so. So a lower RPI rate would decrease the value of the pensions. If you have a personal pension and you're going to be buying an annuity with it, annuities, the payouts from annuities are index linked, meaning that they track inflation. So ones that are linked to RPI, the payments are going to rise more slowly. A lot of the pension companies invest in index-linked gilt bonds, which are government debts, and their value also tracks RPI. So that means the amount that you earn from investing in them, if it's tracked to RPI, that will also drop. So for pension people in receipt of pensions in the future, which is all of us, we are going to be more negatively impacted by this. However, there are some winners. So for those of you who commute by rail, the annual increases to the regulated rail fares, which includes most season tickets, they're capped using RPI. So if RPI is less, the rail tickets might also increase by lower than they would have done otherwise. Student loan borrowers, so those who are on Plan 1 student loans, that's those who were taken out by people who started higher education between 1998 and 2011, and for Scottish and Northern Irish students starting after 2012, they're charged interest at a rate that's the lower of RPI or the Bank of England base rate plus 1%. So the chances are that the student loan repayment interest will be lower. And Plan 2 students, which those taken out by students from England and Wales who started university after 2012, they are charged interest at RPI plus up to 3%. So again, they're going to be winners. Now then, one that will get possibly more of you, mobile phone contract customers. You see, I've got your attention now. If you were drifting off on a Monday morning, most of the major mobile providers use RPI to calculate the annual price increase of the phone contracts. As they're written into contracts, you can't usually escape them because if you try and leave, then there's a penalty clause. But if RPI was lower, then there would likely to be a drop in the price rises. And air travellers and car users, so we've got air passenger duty and vehicle excise duty, otherwise known as car tax, they are also linked to RPI. So a drop in RPI could lead to a drop in airfares and car tax. National minimum wage. I've mentioned in previous updates how increases to national minimum wage come about, but you never know if at some point you're going to be asked a question, so we'll give it a bit more background. The Low Pay Commission, or LPC, is an advisory non-departmental public body, and its purpose is to provide independent advice to the government on matters relating to the national minimum wage. The aim of the LPC is to recommend levels for the national minimum wage that will help as many low-paid workers as possible without having any significant adverse impact on employment or the economy. So they offer advice to the government based on the evidence that they've got at the time. So until recently, one of the aims of the LPC was that the national living wage set by the government should reach 60% of median or middle earnings by 2020. And the increase to £8.72 this April meant that that was the case. They'd achieved that aim, 60% of median earnings. So the government set a new target for the national living wage to reach 2/3 of median earnings by 2024. But the COVID pandemic has had an effect, with furlough skewing calculations of what genuine earnings are at the minute, as well as that economic certainty as to whether employers can cope with an increase. So where does that leave us for national minimum wage for next year? Well, next year, you can see what the rates are there. The approach this year has been to recommend rates that minimise significant risks to employment, but which workers should still be able to live on. So the Low Pay Commission has recommended the national living wage of £8.91, and that's been accepted. It's lower than what they thought originally, because to get to that 2024 target, they thought that it would need to be £9.06 this coming April, but they've abandoned that idea for the now. So £8.91. But look to see the national living wage comes in for people aged 23 and over. So the age at which you get the national living wage has reduced, and the general idea is that you will receive the national living wage by age 21 by the time we get to the year 2024. So, COVID-19 roundup. It seems as though COVID-19 has a permanent place on the payroll update agenda, but hopefully progress made towards a vaccine should mean its days on the agenda are numbered. There's been a big change to what I've told you in previous updates, and the CJRS, the Job Retention Scheme, has been extended until March. I'm hoping that that means that there's some stability for a few months, but there is a change to the reporting deadlines, which is causing major issues. So let's hope that that's one change that does come, but more of that in a minute. So just a recap then. The launch of the job support scheme that was due to start on the 1st of November has been postponed. So too has that job retention bonus, which was no longer now going to be paid in February. Instead, there's an alternative incentive plan, but that's going to be introduced later. There's a deadline imminent. So instead of the job support scheme, we've got a new iteration of the coronavirus job retention scheme. And so the deadline for any claims under the old existing scheme is today, 30th of November, for claims from the 1st of July to the 31st of October. Some employers have ended up missing out on the grant because they've got their claims in late. So make sure that you get any claims for up until the 31st of October have to be in by the close of play today. CJRS 3 came into play from the 1st of November. We've now had 3 versions of the coronavirus job retention scheme. Each one has slight differences from earlier versions. So what's new about this version? It runs until the 31st of March for all parts of the UK. The government will pay 80% of employees' wages for the hours not worked, up to a cap of £2,500 a month, though the policy will be reviewed in January. Employers and employees don't have to have used the scheme before, so you can claim for employees who were employed on the 30th of October, as long as you've made an RTI submission to HMRC between 20th of March 2020 and the 30th of October 2020, notifying a payment of earnings for that employee. That means that you might be able to furlough employees who weren't previously eligible. If an employee's fixed term contract expired on or after the 23rd of September, they can be re-employed and claimed for. And this applies as long as the employee was employed by you on the 23rd of September and you made an RTI submission to HMRC between the 20th of March and the 30th of October, notifying payment of earnings for that employee. There are definitely going to be winners and losers under this, because we have to use the reference pay in February and March 2020 for pre-existing eligible employees, even if they've had a pay rise or a pay reduction since, whereas newly eligible employees, the ones that you couldn't claim for before, will have their usual pay and hours based on their earnings since they began employment or this tax year, if they've been employed in 2019-20 but weren't previously eligible. So be careful, you might well have two different pay reference periods for different kinds of employees. Apprentices can be furloughed in the same way as other employees, and they can continue to train whilst on furlough. But apprentices must be paid at least the apprenticeship minimum wage, national living wage, as appropriate for all the time that they spend training. That means that for the time spent training, employers must cover any shortfall between the amount you can claim for the wages through the scheme and their appropriate minimum wage. Employees on statutory notice period. If you've got to make redundancies, you've got to do so in accordance with the normal rules. This includes giving a notice period, consulting staff before a final decision is reached. For claim periods relating to November, you can continue to claim for a furloughed employee who is serving a statutory notice period, but grants can't be used to substitute redundancy payments. But for claim periods starting on or after the 1st of December, you cannot claim for any days on or after the 1st of December during which the furloughed employee was serving a contractual or statutory notice period. If an employee subsequently starts a period of notice period, a contractual statutory notice period, on a day covered by a previously submitted claim. So if you've already submitted a claim and then that person goes on to a statutory notice period, then you're going to have to adjust that claim. Now then, a very interesting one. We know that there have been so many reports of CGRS fraud with employers claiming furlough payments for workers that they're actually making work as well. So in an effort to deter this, for claim periods from December onwards, employees will be able to find out if their employer has claimed for them under the scheme, and the following information is going to be published on gov.uk. So it's going to be the employer name, an indication of the value of the claim, the company number for Companies House, and it will also be included in the personal tax account. So every worker that has had a furlough grant claimed for them will be able to view that in their personal tax account. So that's another reason for people to get used to looking at the personal tax account as well. So just to summarise then, because it is a little bit confusing where we're going back to the rules that applied in August now. So for claim periods running up to January 2021, employees will receive 80% of their usual salary for hours not worked, up to a maximum of £2,500 per month. So if you think from November you've been claiming 60%, but for October you've been claiming 60%, but now you can claim 8%. The employer contribution during the CGRS extension to January will be the same as in August. So they don't have to contribute to the wages, but they do have to pay the employer pension and national insurance contributions. The employers don't have to have used CGRS previously. Employers across the UK can claim whether or their business is open or closed. Employers can claim for employees who were employed and on the payroll on the 30th of October, but they must have made an RTI submission to HMRC between 20th of March and 30th of October for that employee. Employers have flexibility to use the scheme for employees for any amount of time or shift pattern, flexible furlough, full furlough. Employees can be on any type of employment contract. So just to put that into perspective, these are the changes. So it started to get so messy with the amount that employers can claim back, reverting back to August. So I thought it was easier for me to include a table that shows all the different rates since March, with the first change taking place in August and then every month after that. We should now have some stability until March, but I must warn you, the scheme is being reviewed in January to decide if the position has improved enough so that employers can start to contribute more after all. So there's nothing guaranteed. Now, the announcement that's making life very difficult for employers is that claims for periods on or after the 1st of November must be submitted within 14 calendar days after the month they relate to, unless that falls on a weekend, in which case the deadline is the next working day. So I've already heard from employers who are going to struggle to meet that new deadline and have raised the concerns with HMRC, who tell me that the new 2-week cut-off for claims was directed by the Chancellor himself. HMRC has fed all the comments back up the chain to the Treasury, but they can't promise that the deadline is going to change. The current instruction is that employers must complete their claim by the deadline and take reasonable care to ensure the claim is correct. Where the 14-day deadline each month doesn't affect an employer's ability to claim in advance of paying the staff. So employers can claim before, during or after the time that they process the payroll, as long as the claim is submitted by that relevant deadline. Where a payroll run won't be complete by the 14th of the month, employers still are required to take reasonable care to make an accurate claim. And where a period spans more than a calendar month, the employer must only claim for the days that fall within that calendar month by that deadline, even where it's outside the usual process. Employers, if they realise that they have made an incorrect claim, can correct it later. And there's a window of 28 days after the end of each month during which an employer can contact HMRC to adjust the claim. So it's important you can see if you've furloughed employees between the 1st of November and the 30th, i.e. today, then you've got 14 days. You have to get your data ready. You have to make sure that you've got all the right detail about the hours that have been worked. Make sure that the employees you want to claim for qualify, and that your grant application is filed on time. And the last bit under the COVID roundup is about the antigen test. So essentially, the test to see if somebody's got COVID or not. There's a new temporary exemption being introduced to make sure that employees who are given a coronavirus test by their employer will not be liable to an income tax charge because it's a benefit in kind. The exemption applies to any relevant antigen test provided by an employer on or after the 8th of December, up to and including the 5th of April. But HMRC does recognise that some employers will have already provided coronavirus tests for their workers. So if any have been provided earlier, HMRC will exercise its discretion and it will refrain from collecting any tax on Class 1A national insurance on the provision of a test. So there won't be any liability due for the 2021 tax year. It's important the exemption will specifically apply to antigen tests, so those tests that say whether or not someone has coronavirus. It doesn't extend to coronavirus antibody tests. That's because antibody tests don't work for everyone, and some people who've had the virus don't produce antibodies anyway. And antibody tests only give a historic view of whether an individual has previously had the virus. Unlike the antigen test, it does not inform whether the individual is currently affected by coronavirus and needs to self-isolate. So just something to bear in mind if your business is providing tests for workers. Other news. Oh, this is a nice welcome mundanity, isn't it? Advisory fuel rates from the 1st of December. We've had a change to the petrol rate for the 1400 to 2 litre petrol cars, which has gone down from 12 pence to 11 pence. Gender pay gap reporting. Gender pay gap reporting was suspended for the 2019-20 reporting year because as a direct result of coronavirus, but we haven't yet had an indication that the deadlines are going to be suspended for the 2020-21 tax year. So at the moment, it seems as though that reporting will still go ahead. So I thought you might be interested in an update on how furlough will impact the calculations that are involved in the reporting process. The Government Equalities Office has confirmed that employees who were paid less than the standard pay due to being on temporary leave, furlough, should be considered as relevant but not as full pay relevant employees, which means any furloughed employees must be counted when establishing what the employer headcount is and included in the calculations when calculating the percentage of men and women receiving a bonus, calculating the average gender pay gap using bonus pay, and calculating the median gender pay gap using bonus pay. So essentially, if bonus is involved, you count them, and you don't count them when you are working out just the actual pay. So you wouldn't count them as full pay relevant employees because they were paid a reduced rate as a result of being on a period of leave. So you exclude them when counting the average gender pay gap for hourly pay, the median using hourly pay, and the percentage of men and women in each hourly pay quarter. If you have any workers who've had the salaries topped up to normal levels, so you've claimed back 80%, but then you've topped up the wages to what they would normally earn, then they would count as full pay relevant employees for the purposes of calculation. And if you've had somebody who has agreed to defer a portion of their earnings, bless you, and were not placed on furlough, then they would also be considered as full pay relevant employees, as they were not paid at either a reduced rate or nil as a result of being on leave. I think everyone is going to agree that 2020 has been quite a year, but despite that, Christmas is almost here and the year's nearly over. And I can't be the only person that wonders how that's happened. How has it been such an awful year, but yet it's nearly at the end of it already and it's come very quickly. So I think we're all going to be glad to ring in 2021, even though we can't celebrate it in the usual way. So in payroll, some things never change, and it's time for the usual reminder about what payment to use on your FPS if you pay your workers earlier at Christmas or at any other time of year, come to that, if the normal pay date falls on a non-banking date. So many employers pay their employees earlier than usual over the Christmas period. It can be for a number of reasons. For example, during the Christmas period, the business might close, meaning workers need to be paid earlier than normal. But paying employees early can affect their entitlement to universal credits because the DWP thinks that they've earned a lot more in that particular month. They sort of forget the fact that, yeah, but then they're not going to get the pay the following month because they've already had it. So DWP will stop the benefits and stop the universal credits. So to correct that, HMRC has issued an easement which, if followed, will correct the workers' entitlement to benefits because it will make it look as if they've received the payment on their normal pay date. If you pay early, you should report your normal payment date on your FPS. For example, a lot of businesses are closing for a full fortnight this year. So that means that for a lot of businesses, the last day before Christmas is the 18th of December. And so they're paying on the 18th of December. So if you pay your workers on the 18th of December, but your normal payment date would be the 31st of December because you pay on the last day of the month, you should report that payment date as the 31st of December, even though you've paid them early. So in this example, the FPS would need to be sent in on or before the 31st of December, the normal payment date. Doing that is going to help protect your employees' eligibility for universal credits. And you can get more information on Employer Bulletin 87. You know the bulletin that HMRC issues? Well, Bulletin 87 is going to be published in the next week or so, and that's got a lot more information about paying early for Christmas. Whilst this slide is purely about Christmas, I must come back to the point I made in my opening sentence about this, which is what to report when the regular payment date falls on a non-banking date. So if you normally pay, for example, on the 31st of the month, but it falls on a Saturday, so you pay on the Friday the 30th instead, then you must report the usual payment date of the 31st on your FPS. So that is normal payroll practice, and you should be aware, you should make sure that your software does that. Never is this more important than at Easter, which often falls around the start and the end of the tax year. The number of times that Good Friday has been on the 6th of April is amazing. I can't work out how it always drops on that same period, because Easter can run anywhere through March and halfway through April. But if you don't stick to the regular payment date on your FPS, especially around Easter, that can mean that payments intended for one tax year fall in a different one. So remember the importance of this rule and make sure that the right dates are on your payroll software. Christmas furlough. Employers should not be claiming furlough just for Christmas shutdown. So furlough is not just for Christmas, as it's not in the spirit of the scheme. But where a furlough period begins before shutdown and continues after, then the shutdown can be treated as a holiday period and furlough claimed, albeit 100% of the pay needs to be paid using the new holiday pay regulations that came in April. So where a bank holiday, such as Christmas, Boxing Day, New Year's Day, where they fall inside a worker's period of furlough and the worker would have usually worked the bank holiday, their furlough will be unaffected by the bank holiday. So that's if they would have worked. But if they wouldn't have worked on Christmas Day, Boxing Day, New Year's Day, so they would normally have had the holiday for it, employers have got two options. So if the employer and the worker agree, then the bank holiday can still be taken as annual leave whilst they're on furlough, and the employer must pay the correct holiday pay for that worker, which means that they'll have to top it up. If the bank holiday is deferred, so if between them the worker and the employer say, well, okay, then we'll just have this whole period over Christmas as furlough, and I'll take days in lieu for Christmas Day, Boxing Day, New Year's Day, I'll take them in April, then they can be bounced over, but what the employer will have to remember is to still pay that full pay for those days when they're actually taken. Christmas parties. Excuse me. Employers can take advantage of an exemption if they provide their workers with a Christmas party. But it's usually an in-person Christmas party, and it's usually that there is food and there is alcohol and whatever. And if, as long as the party meets certain criteria, then it is exempt, and the worker is not subject to tax and national insurance, because that'd be a bit of a blow if your employer puts on a nice party for you and then you have to stump up an income tax charge for it. So the Income Tax, Earnings and Pensions Act 2003, otherwise known as ITEPA, for all you learners out there, remember you might be asked to name this in an exam. That includes an exemption which says that as long as certain conditions are fulfilled, then an exemption will apply, meaning the employer doesn't have to report the event as a benefit in kind, and there's no income tax or national insurance to be paid. HMRC has now confirmed that the exemption that applies to traditional Christmas parties will now also apply to the costs associated with virtual parties, as long still as that criteria is fulfilled. So that ITEPA exemption will now apply to providing food, entertainment, equipment and other expenses which an employer may occur when hosting a virtual event. The normal conditions of the exemption must be met, so the party or similar function must be all of the following. It must cost £150 or less per head. It must be annual, so it applies very often for Christmas parties, but some employers use the exemption as a summer barbecue or something like that, so it must be annual. Has to be open to all employees of the business, and where the conditions are met, the employer won't be required to report anything to HMRC, and there'll be no tax or Class 1A NICs to report. So now we're just moving into the final part. Just to remind you of training opportunities. Hopefully quite a few of you are already studying an apprenticeship with us, whether it's payroll administrator level 3, payroll manager level 5. But we've got a new kid on the block now. We've got the Quality Practitioner Apprenticeship, which is level 4. If any of you are thinking about something different, or if there's any managers on the call, have you got any workers that you think might value the Quality Practitioner level 4? Remember, through membership of MBKB, you get the monthly updates as a webinar like I'm doing now, and you get the monthly newsletters which come out on the 3rd Friday of every month. If you don't think that you're receiving them, check your spam or junk email folder, because we know that some are going in there. And if you haven't got one in there, but you would like to receive the newsletter, then just go to Payroll website, and on that homepage you can subscribe to the newsletter, so it just helps you keep up to date with what's going on. And if you have a payroll question that you don't know the answer to, drop us a line at payroll support. The address is on that slide, and one of our experienced payroll practitioners will get back to you with the answer. If you're interested in taking advantage of one of the training courses or one of the qualifications, then get in touch with the team on that email address, train@mbkbgroup.com. The next payroll update is going to be off-payroll working in the private sector. You'll remember that we covered off-payroll working in October's update, but I know that quite a few of you weren't able to make that slot, so we were asked if we could run it again. So that's what we're going to do. It's on the 26th of January between 10 and 11. I'll be delivering it. I'll be using a lot of the HMRC provided content, because HMRC delivered the session for us last time, and they've said we can use their content to deliver the next one. But it will also include some updates that have come out since, so there's been some changes to the rules for umbrella companies, so I'll include that. I must stress that this is important to each and every one of you if your organisation has got more than 50 employees, because if you're in the public sector and you think, oh, well, that's okay, I've been doing this since 2017, I don't need to worry about it. Yes, you do, because there's some changes that come in next April that apply to public sector as well as private sector. So there's things coming in that you aren't doing at the moment that you will need to. So there's a lot of preparation to do before the changes, especially with furlough and the start and end of the tax year, which is just business as normal anyway. So you need to get organised, and I'm going to cover everything that you need to know. I'm going to look at the process that you must go to assess the status of those who provide services. Remember, it could be someone who's been providing services to you for the last 20 years, and now all of a sudden their status has to change. I'll go through the status determination statements, what the information requirements are, where the liability for payment will lie. I will also look at that disagreement process as well and what you need to do. So if you want to book, the link is on the screen there, and I'll be sending out the slides after the event anyway. So do we have any questions? There have been none in the chat box as we've been going along, for which I've been thankful. Any other questions now that I can focus just on the chat box and I don't need to worry about talking at the same time? I'll just give you a few minutes just to see if anyone's going to type anything in. I don't want to cut the call off too soon. Looks like we haven't got any questions, so I will thank you for your time this morning. I will send the slides out. If you do have any questions after the event, you will get my email address when I send you the slides out, but you can also use that email address that's on that second to last slide, the payroll support email address, and any questions you can send through there, and we monitor that inbox all the time. Okay, I will wish you a very good rest of the week, and hope to see you next time. If I don't see it or speak to any of you before, have a great Christmas and see you in the new year. Take care. Bye-bye.